Good morning, everybody, and good afternoon. Thank you so much for joining us today. Happy August. Welcome to our continuing webinar series here at Home Express. Today's webinar is Bring Your Scenarios. So let's go ahead and get going. As always, I will read our disclaimer. The content of this presentation is proprietary and confidential information of Home Express Mortgage Corp. It is not intended to be distributed to third parties not participating in this webinar without the written consent of Home Express Mortgage Corp. And we thank you for your support and consideration. As always, here's just a brief snapshot of our agenda today. We're going to just take a look at the mortgage market as we've been doing recently, talk about some scenarios that we've brought to the conversation today, and we would like to hear some of your scenarios. So David Greider will mention that in just a bit, but feel free to put them in the chat. And then as always, we'll take a look at next month's webinar and give you our Home Express website and contact information. Let's take a look at our panel today. David Greider, welcome back, our SVP of Wholesale Lending. Of course, it's wonderful to have you here. Again, everybody, my name is Andrea Formato. I'm the Sales Training Manager here. And we have Ray Menina on, who's our SVP of Strategic Initiatives. Ray, I'll go ahead and turn it over to you to say a couple words.
Yes, thank you very much, Andrea, and everyone, welcome to the call. These webinars are geared towards providing you relevant market updates as well as product information that can help you capture more business. Home Express started in 2015 as a specialized non-QM wholesale lender dedicated to serving mortgage brokers. The company was founded by seasoned executives who truly understand non-traditional lending and are committed to serving borrowers who may have unique situations that prevent them from qualifying for traditional loans. We've evolved into one of the top non-QM lenders nationwide due to our Make Sense underwriting approach, our industry-leading pull-through ratio, and our focus on speed, ease, and convenience. Today, our presenters are David Greider, who is our SVP of Wholesale Lending, and Peter Garfinkel, our VP of Credit. They will walk you through some of the unique characteristics of non-QM loans and more importantly, some common scenarios solved with non-QM loans. Without further ado, David and Peter.
Hey, thank you, Ray. I appreciate the comments. And we're going to go to the next slide. And I thought it'd be great to bring in kind of a special guest, Peter Garfinkel, who is our Vice President of Credit. We've both been in non-QM since the beginning, 8 years now. So it's great to get a perspective from our kind of viewpoints, and then credit, because he deals a lot with investors and the due diligence companies that kind of regulate and the bond market and put ratings in. And it was like last month, I wanted to talk a little about the mortgage market today because there's been a lot of news over the last 90 days about non-agency lenders, and then beginning of the year, some of the locks and stuff that were broken and just some of the changes that I've done. So I went a little bit over that last webinar, but I'd like to have from a credit standpoint, Peter Garfinkel will give a little color on the challenges of 2022 and then how Home Express has dealt with that. So Peter, could you give us some color on mortgage market from a credit perspective?
Sure thing. So, 2022 is definitely a year of challenges. I'm sure everybody has witnessed in one way or another. Now, from the origination side, the challenges are these increasing rates. That is true for us as well, right? We continually are out there trying to determine whether or not we need to increase rates, what the secondary market's going to be, and what that means back to our consumers. That has been probably the biggest challenge of the year. But you start to layer in some of the other challenges that presents in a market where increasing rates slows the housing down. Slow housing usually leads to some depreciation or maybe a slowing in the housing appreciation curve, depending on what pocket you're in. So when you start to layer an increasing rate market where it's not been a linear increase, it's sort of been up and down quite a bit, herky-jerky, as you would say. So we're constantly trying to predict where we need to be on rates while values are starting to depress a little bit in certain markets, certainly slowing down across the nation. You come into an environment where we have to start looking at some of the fringes of the offerings, right? So you've already seen Home Express here take some responsible changes, as well as some of our other people out there in the market, where we've reduced some of those higher LTVs. That's from an HPA concern. We've reduced opportunity for some of those really, really low credit scores as well. That's from an ATR increasing rate concern, right? So that's really the name of the game right now. You layer in a little bit of the liquidity of the market. We won't go down the economics of that, what it means for the secondary market, but being a firm that is well capitalized, has a large partner behind it, is going to be crucial for everybody moving through the second half of 2022.
Awesome. Thanks, Pete. And again, if you want some more color on our company, we're glad to share that with you individually. And at the end of the webinar, you have our contact information. But we're here to help you and get your loans closed. So let's take a look at some scenarios that, and I randomly went through, just last week, to say what's funded, what's going on. These are real life scenarios that are in our system, either funded or about to fund. So the first scenario we have is a purchase request, self-employed borrower, no tax returns, trying to utilize their personal bank statements, and they have no business account. So we start looking at the business. It's an entertainment type of business, actor, host, and we got a little self-employed questionnaire they fill out. FICO is 745. Looking at putting 25% down, but the challenge is kind of a different type of business. So what expense factor do we apply to this type of business, because it's a little unique? Well, we utilize a tax preparer's expense factor letter who's prepared to borrow taxes for the last 4 years. And this purchase was submitted to us on July 15th, and it funded August 2nd. So, hey, Pete, from a credit standpoint, what's your take on this?
This is kind of a great snapshot of what we do here at Home Express, right? So we tend to want to be as common sense as possible, right? Does the loan make sense? And inside of that sort of philosophy is, what can we do and be flexible inside of our guidelines, or maybe a little outside of our guidelines, to get a loan done? You see this loan, and instantly what pops out at me is a good down payment and a high FICO score. And that's pretty representative of our overall pipeline. The challenge here, as you mentioned, Dave, is that this isn't your typical self-employed kind of guy. Well, we had flexibility to go out and get that tax preparer's letter instead of using a standardized expense factor that may not have gotten him the ability to qualify. Additionally, we were able to use personal bank statements when no business account was available in order to qualify the borrower as self-employed.
Awesome. Thanks, Pete. Let's go to scenario 2. And again, we're going to go through 5 of these and then get to yours, right? This one was a Texas A6, that's cash out, self-employed less than 2 years. Okay, kind of a little unique situation. The LTV requested was 70%, loan amount was $611. And here we had a professional dentist that was a W-2 at a different practice for several years, then went on his own 19 months ago. And we utilized a program we have called the cash flow program for self-employed greater than 1 year, but less than 2. That's in a like industry, usually supervisory or managerial professional in nature. And this one came in on June 22nd and funded on July 18th. So Pete, some comments?
Once again, right here, we've got 70 LTV, kind of the recurring theme we talked about in the last scenario, where we have borrowers that have equity or have a reasonable down payment. That really helps us get through some of these unique or tougher situations. This borrower, obviously, whether he's a full doc borrower or he's a bank statement borrower, he's going to struggle with a recent change in his structure of employment. 2 years is the golden rule out there for agency, non-QM. Just about everybody's looking for that 2 years. We've got a program, Dave, you talked to it in brief there. It's called the cash flow program. It's a subset of our bank statement or alternate doc programs that allows a professional individual to go from a W-2, stay in that same line of work, whatever profession he is, doctor, lawyer, type of person, go start his own practice, and then we'll use 12 months to qualify him, get him in there, support the fact that he's got a history of doing this. We realize that's a real life scenario that people are faced with every day. These are solid borrowers, and we want to make sure we can support that through this cash flow program as they change and advance their careers.
Hey, thank you, Pete. Let's look at number 3. W-2 teacher that has a self-employment tutoring business for several years. Now, I kind of looked at this one, you know, obviously there's probably a DTI concern going tax returns through traditional Freddie or Fannie guidelines, but this is a purchase, state of California. You know, you see the purchase price, looking for 80% LTV, FICO's 801, and we're able to use both sets of income on this, the W-2 and the bank statements for the self-employment, and combine those to qualify the DTI. This was submitted June 30th and funded July 26th. I'll hand it over to you, Pete.
Yeah, you know, this is one of my favorite ones we've got, right? I love these scenarios because this really does show how we can be flexible inside of the income and how we really start to utilize all the different tools in our toolbox, going W-2 on part of the income, bank statements on the other, ultimately to combine and get this borrower a solution to get that home. And you look at the profile once again, 85 or 801 FICO, 80 LTV, alternative income situation. You know, that's one of the things I think that our guidelines allow us to do and get in and really flex this and understand how these different sources of income, how that flows in and allows them to meet the ATR requirements.
Thank you. Let's look at number 4 coming up here. Purchase of an investment property in Texas. It's a small to medium investor type, has a couple other investment properties. And you kind of look at it, the request comes in, 35% down payment, FICO 687, loan details are there. They want to utilize our DSCR program. That's qualifying the borrower on the cash flow of the property versus going income docs on a DTI, which we could do both. But it was unique on this that you went through it and the 1007 came in slightly lower, right? And the broker and AE get together, hey, let's just finance on top of that, two discount points, lower the rate, so our DSC was over 1. Submitted June 15th, ready to close. It was CTC 7/11. I guess the seller and buyer want to postpone it, probably someone living in there or had to do it, but until July 25th. But Pete, I like this one, and for your credit perspective, because the 1007 sometimes do come in light, and how to deal with those, right? So if you could take some comments on that, would be great.
Yeah, you know, as we kind of kick the meeting off, there's contraction in the market right now, and the DSCR is one of those areas where there's been a bit of contraction. And some of that has been with inside of that DSCR, that ratio in there and the qualifying of it. Well, while that may be reasonable and understandable, where the challenge really comes in is understanding what rent should be used to qualify the loan and calculate that ratio for the DSCR. The appraisers are usually a little out of the loop, right? They've got to go out to MLS, their only source of real information. They get that information and they try to complete a 1007. Well, unfortunately, not all rents are listed in the MLS. It's not the best source, right? So we look at a couple different ways that we can attack that one. 1007 is always acceptable. It's the preferred method, but it's not always the best. We also allow for actual rents. So we'll call 1007 being market rents. We'll call actual rents being a lease agreement that is got 6 months remaining on it and some receipt of the current rent, and we'll use that to calculate the DSCR so that we can take the real world situation. Once again, you know, I've kind of mentioned that, said that a couple times, I guess, on these scenarios. Real world situation, common sense approach to these loans. That's really what we want to take and bring to you guys out there. Also, we have a tool out there that allows us to figure out what the rents are in that area. So if you guys are suffering, trying to figure out, is this going to qualify for a DSCR or not? You're struggling to try and get that same information, reach out to your AE. They can help you get some information about what the rents are in that area and whether or not we need to provide more information to the appraiser when we're ordering that appraisal to say, hey, here's some great comps in the area, or if we need to go to an actual rents versus market. Lastly, as you've demonstrated here, Dave, we've got the ability to take and finance some points to get that DSCR down. And also, if we're using an interest-only loan product that we do offer on the DSCR, we will qualify them off of the interest-only payment for the DSCR calculation. So lots of different ways to help solution this in a contracting market.
Hey, thank you, Pete. Yeah, we'll take the last one that I kind of put on here, scenarios, at number
David?
5.
Sorry,
What?
before we move on, I'm sorry. We just had a quick question come in, and I know you won't mind. Before
Sure.
we go to scenario 5, but Pete, could you maybe put a finer point or clarify on what exactly is a 1007? What's the process around that? Who's responsible for getting that, and what exactly that does?
Absolutely, no problem at all. So 1007 is kind of the industry generic term for a rent survey provided by an appraiser. It's sort of a little bit of a misnomer to say 1007 covers all properties. There is also a 1025 out there for units. It's the same kind of thing. A 1007 is an additional form embedded in the 1004, which is your standard residential appraisal for single family PUDs and condos. Your 1025 is for your 1 to 4 unit residential properties. Both of these, if you have a 1004 with a 1007 or a 1025, will provide you with a rent schedule. And that's when the appraiser has gone out and looked at rentals in the area, figured out what they rent for, and then spread that across just like they do comparable sales to derive at a rental amount for that property. That would be ordered at the time of appraisal via the broker to get that ordered. We at Home Express don't order those. They do get ordered with the initial appraisal. Those come in and they give us the market rents off of that.
Great, thank you so much. Let me go ahead and advance to the next scenario, David.
Great. Okay. Thank you. This one came in, purchase new construction in Texas, borrower currently renting in Florida now, relocation, and will have a job change. Wow, that's a lot of moving stuff here, right? Again, let's look at the borrower here and some of the characteristics. FICO 805, 25% down, and assets well over $1 million. Now, we used our asset in full, which we call Asset Express, to qualify that. So under Dodd-Frank, on a consumer loan, you have to pass some type of ATR, right? The ability to repay. In that subset, you can use both income or DTI or assets to qualify ability to repay. So we have on our guidelines, Home Express requires 125% of the loan amount, and that's after funds to close on that, and that passes ATR. So this loan amount was approved. The actual LTV was 76.5 because the broker utilized financing the broker fee on top of that LTV and keep the same pricing at 75. And it was submitted just recently, July 25th, and we approved it on July 27th. So Pete, want to take a look at this one?
Yeah, sure. Relocations are always tricky. Whether they're self-employed, whether they are a wage earner, they're tricky, right? Because people are moving areas and there's instability there. The mortgage industry loves stable and predictable income. It's one of the tenets of income is that it's stable and predictable. And a relocation may interrupt that. Using a program like an Asset Express takes that out of the equation and allows us to get a borrower like this financed for a property. They can get settled into their new position and continue to have, a fulfilling life at their new spot. W-2 borrower and relocation a little bit easier. You get a scenario where they are changing jobs, changing locations. They've been at the job for a long time. That starts to show stability. You get a pay stub at the new location or new company they've moved to. You're better off as well. But when you get into the self-employed borrowers, it gets a little tricky. Asset Express is a great solution for that because we take the instability of the income out of the equation.
Yeah, thank you, Pete. As we go into your scenarios now, and I hope you got some there in chat, and just keep in mind what we're here to do. We're here to help you close the deals that do not get done through traditional financing or through what you have available internally at some of your broker offices. So when you look at some of the deals, I'm trying to spur your mind and say, have those situations came up? And I've been in belief, and I've been doing this since 2015 in non-QM, is that there's deals that loan officers had they didn't know what to do with, and they passed on them. And so when you look at it, just don't automatically say no if hey, this doesn't work through Fannie or Freddie or some of the programs you have internally. What you need to do is call one of our account executives that are highly trained on structuring your deal. You don't have to know all these programs. What you need to do is call one of us. We know these programs, and we can help guide that and structure that loan so it gets submitted and closed timely, so we can close your purchase on time. So with that, Andrea, let's take a look at some of the scenarios that were put in.
Sure, thanks, David. And before we move on to that, Pete, really quickly back to the DSCR, would you be able to just do high level on how we calculate DSCR?
Yeah, absolutely. So DSCR is a fairly easy calculation at the end of the day. So everybody out there can do this on your own. You take the PI-TIA, A for association if it's applicable, and you divide that against your rents, and that will give you a ratio, right? So if you have $1,000 PI-TIA and $1,000 in rent, if you were to divide those against each other, you'd get a 1. That's a 1-to-1 DSCR. DSCR standing for debt service coverage ratio, which just means are you covering the ratio with which you're covering the debt of the property. If you are doing an interest-only loan here at Home Express, don't include the P because we don't include the principal. It's an interest-only payment, so it'd just be the interest, taxes, insurance, and any association dues as you're doing that calculation.
Great, thank you so much. So we do have a couple scenarios, David, in here. The first one has to do with what about a borrower that is living rent-free with their sister for the past couple of years, so there's no housing history. This person's self-employed and they want to use gift funds. Can you talk a little bit about that?
Yeah, no, that's a great, that is the scenario that's real world out there, right? So typically when we look at someone that's living, rent free, and that is really what are they doing during this period of time? Are they doing the right financial or maybe the good financial move? Probably be to save the money up for a down payment, right? Now, if we can document that over the last years where they're living rent free, that's a good thing, right? So typically we look at that, hey, no housing history. We kind of look at the credit trade lines. If they shouldn't have much in the consumer debt world because they're living, without a housing payment. And if they saved up their money and they have the money down at least 5% of their own, we would love to take a look at that. And those are deals we close all the time. Pete, I don't know if you want to comment on that.
When it comes to that scenario, I want to talk a little bit more in general about that when we're looking at people that have done the right thing versus necessarily not the right thing as they're coming into becoming a homeowner or purchasing a property. We're going to reward those that have done the right thing, right? If they've been able to save up the funds, they've been able to get the reserves, the down payment, all the things that they need that are financial responsible decisions to get there, we're going to weigh heavier on that than we would the fact that they've been living with their sister rent free. The people that are maybe not making the best financial decisions are the ones that are living rent free, haven't saved up any money, kind of have a bunch of debt, and really aren't thinking about becoming a homeowner, right? So those that have thought about it and have taken the right financial steps, those will be rewarded. We have more flexibility inside of that than those that aren't. In this instance, there is some mention of gift funds in there. That may not be the end of the day, right? Because the borrower's still been on the right financial path to get himself to home ownership and just needs that little extra push to get there. So it sounds like a pretty reasonable scenario. And like I said, first-time home buyers, there's kind of two paths, and we want to always reward those that are on the right path.
Great, thank you. Here's a question that came in. Since these are non-QM loans, are these still subject to PMI under LTV ratios?
Great
I'll jump in
question.
on that one, Dave, if you want.
Go ahead.
So we have, none of our loans in the non-QM space have any PMI or MI. So all of our loans, regardless of LTV, you have the rate, that's it. There is no additional insurance on top of it from a private mortgage insurance company or some sort of agency. That's one of the great things about non-QM is there's not that extra little bump that you got to pay for on top of the rate you already have to qualify for. Additionally, there is no upfront fee like you would on, say, an FHA loan for those insurance products. So we are a private mortgage insurance free environment where our rate is our rate.
Great, thank you. David, we're going to say something. Sorry, before I go to the next one.
No, let's go to the next one here.
Okay, let's go to the next one. So this is two borrowers that recently moved to a different state. They are selling their property for funds to close and reserves if needed. They have new jobs, the same line of work. One company is a W-2. They don't have a paycheck stub yet. The second borrower was a W-2, now 1099 under 2-year contract. So how would we go about handling that?
Yeah, a lot of moving parts here. And again, you get these, give us as much information as you can on these scenarios to our account executive to be able to structure this. So I would look at this as, hey, this is a common theme the last couple of years, is like moving from one state to another state and recognizing that they might have a job change or go to a different company. And Pete did comment the W-2 is probably a little bit easier to document than someone maybe self-employed. But if they're like doing the same industry and the credits there, we can see what they're paying now as far as a housing payment kind of matches up. We would love to look at that and try to get those deals done. I've seen similar ones done here all the time, but we need to have a proper documentation understanding of that particular job move, and that it makes sense and that we have the proper documentation, especially before you fund it, like first paycheck stuff, and it all makes sense. So Pete, I'll let you talk a little bit about that.
Yeah, you know what? A couple things I heard in that scenario that I really like, right? I heard same industry. I heard somebody was W-2 that's got, the same employer or something similar where they're going to get a pay stub. And then I heard, hey, somebody went from W-2 to 1099, perks me up a little bit. But then I heard 2-year contract, right? So going back to when we were talking about relocations before, stable and predictable nature of income is key to success. And that does get disrupted in relocations. But in this scenario, it definitely sounds like we have the stable and predictable nature of the income. So lots of, like you said, Dave, lots of moving pieces, right? You're gonna anticipate if you have a scenario like that, that you may have an extra layer of documentation that you may have to get to really shore up all these things. You may have to wait for those first pay stubs or paychecks on the 1099 guy to get there and support that this transition has taken place. But this isn't something we'd shy away from.
Great, thank you. There is another one that just came in. What about a customer who's buying a 3-plex and wants to live in 1 unit? Can they do a DSCR loan and they just sold their primary within 30 days?
Wow. Okay, so if they're going to live in the triplex, we would have to qualify on TRID because that's a consumer product. So we would have to look at that. However, we can use the rents from the other two units, right? So it's a 3-unit to look at that income. I don't know if they're vacant now, or what is on this purchase, or they're existing in there. But there's ways to do that, and then kind of look at some other things they have, like assets, right? We talked about this one borrower that was moving from Florida to Texas, and we used asset in full or asset express. We also have asset depletion, especially if they're selling the house they're presently in, might have some opportunity there, even if the income's a little short, to look at the assets to qualify. Pete, you want to take a stab at that one as well?
Yeah, I think you're spot on, Dave. I think the key there is making sure we're utilizing those rents to offset the payment. Obviously, a DSCR can't work in this environment because DSCR is designed for non-owner occupied properties only that are meant to be a business purpose. This would be a consumer purpose loan. We have programs for that. Use those rents to offset. This is a pretty typical scenario right now as housing continues to increase. you get a way to offset. You don't have the roommates, but you got rental units, right? So not a bad move in today's environment. Definitely something we can approach.
Great, thank you. And I believe that that is all the scenarios we have. So I'm going to go ahead and continue to the next slide. And Ray, I will hand it back over to you.
Yes, thank you, Andrea, and thank you, David, and especially our guest speaker, Peter Garfinkel. I hope everyone has a better understanding of non-QM loans and how you can use them to solve for some challenging scenarios like what they went over with you. As mentioned earlier, these webinars occur monthly, so feel free to join us each month and invite any colleagues you think can benefit from these informational sessions. Our next webinar will be presented on September 15th, and the topic will be needs-based selling, so you're not going to want to miss this one. I'd like to thank our loyal customers who continue to use Home Express as our primary non-QM lender, and we humbly invite those who are not currently partnering with us to join us. To learn more about Home Express or to view a previously recorded webinar, please visit our website at www.homexmortgage.com. So with that, if you look at the next slide there, Andrea, we do have some contact information for both David and I. So feel free to contact us again if you have additional questions or you're uncomfortable in asking a question in this venue. Well, we will also be sending a copy of this deck to all of those who have registered. So look for that coming to your email box very soon. Thank you very much, folks, and we're looking forward to seeing you on our next webinar on September 15th. Have a great day, everyone.
Thank you, everybody. Take care. Bye-bye.